Welcome to our deep dive on using loans to bridge the $800,000 capital requirement in investment migration. We will start with the big picture of why loans are permitted and why scrutiny is intense, then gradually move into rules, source of funds tracing, documentation workflows, and practical tips. Along the way, we will introduce diagrams to visualize the process and include short quizzes to test your understanding. Finally, we will close with a concise summary and a compliance-focused disclaimer. Here is our agenda. First, we will explain why loans are allowed. Next, we will cover the exact rules of debt financing. Then, we will address the source of funds controversy and walk through the financial audit chain. Afterwards, we will outline a step-by-step documentation plan, compare private versus bank loans, and identify common pitfalls with fixes. Finally, we will wrap up with key takeaways and a compliance disclaimer. Loans are generally allowed in investment migration because regulators care that the investment is genuinely at risk and that funds are legal, rather than whether the capital is borrowed or owned. However, because loans introduce third-party funds, the scrutiny increases dramatically. Authorities will require you to prove the legal origin of both your funds and the lender's funds, which significantly expands documentation requirements. With that established, let us move into the precise rules. There are 3 core rules. First, you cannot use the project or the business you are investing in as collateral. Doing so would undermine the requirement that your capital be at risk. Second, you may use personal assets you already own, such as real estate or stocks, as collateral for a bank loan, as long as the ownership and value are properly documented. Third, private loans from family, friends, or other private parties are allowed, but you must thoroughly document the lender's source of funds. Now that we have the rules, we will transition to the most controversial part: source of funds tracing. This mind map should present the central concept of source of funds tracing and split into applicant funds, bank-backed loans, and private loans. Under bank-backed loans, it should show the specific types of collateral, like real estate and securities, and require proof of how each asset was originally acquired. Under private loans, it should branch into the lender's income type: salary, dividends, business sale proceeds, inheritance, and list documents such as contracts, tax returns, audited reports, and bank statements. Finally, it should converge on clean endpoint proofs like verified employment records or government pension statements, indicating where enhanced due diligence is typically applied. Source of funds rules require comprehensive tracing of all money used for the investment. It is not sufficient to present a loan agreement. You must also document how the collateral was originally purchased in the case of a bank loan, or how the private lender lawfully obtained the funds. These requirements are grounded in anti-money laundering standards. As a result, borrowing increases the volume and depth of evidence you must provide. The audit chain extends beyond the loan documents. For a bank loan secured by a house, you must show how the house was originally purchased and funded. That typically involves employment records, tax filings, bank statements, and purchase contracts. For a private loan, the focus shifts to the lender. You may need the lender's employment contracts, tax returns, dividend records, business sale agreements, and bank statements. Investigators will continue tracing until they reach a verifiable and legitimate source, such as government pension records or documented employment income. With that mechanism understood, we can now translate it into an actionable documentation plan. Here is a quick checklist in Markdown style to guide your preparation. First, decide whether you are using a bank loan or a private loan. Second, ensure that no project assets are used as collateral. Third, prepare source of funds documentation for yourself and any lender. Fourth, gather proofs that link the amounts to legitimate income or asset sales. Fifth, maintain a clear bank statement trail from the source to the final investment. Finally, create an index of documents that includes dates and certified translations where necessary. Next, we move into a more detailed step-by-step plan. To operationalize your application, start by mapping your financing structure and splitting amounts by source. Next, validate the non-negotiable rules. Collateral must come from your personal assets, and the investment project cannot be pledged. Then, assemble your paper trail, including contracts, statements, tax filings, payslips, audited financials, property deeds, and brokerage records. Trace each inflow backwards to a clean endpoint proof. Reconcile your totals by linking each transfer to specific documents and bank ledger entries. Prepare certified translations and notarizations as required. Identify and preempt red flags with additional evidence. Finally, compile a submission index of numbered exhibits with cross-references and dates. Now that you have a plan, we will compare private loans to bank loans. When using a private loan, you gain flexibility and may not need formal collateral, but authorities will closely scrutinize the lender's source of funds, and you might have to provide relationship evidence and extensive records. Documentation quality can vary. With a bank loan, you benefit from formal underwriting and predictable documentation. However, you must prove the legal origin of the collateral used to secure the loan, including how you originally acquired assets like real estate or securities. The trade-off is between flexibility and documentation predictability. With that in mind, let us test your understanding with a quick quiz. Quiz time. The question is, can you use the assets of the new investment project as collateral for your loan? The options are A, yes, that is preferred. B, no, the investment must remain at risk. C, only if the lender is a family member. Or D, only for a partial amount. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. You cannot use the assets of the new investment as collateral because the capital must be genuinely at risk. Second quiz question. If you take a private loan from a relative, whose source of funds must be documented? Options are A, only yours, B, only the relative's, C, both yours and the relative's, and D, neither, just the loan agreement. You may pause the video now to think about the answer in their video. We will discuss the answer in the next section of the video. The correct answer is C. When you use a private loan, you must document your own source of funds and the lender's source of funds, because the tracing must reach a clean and verifiable origin for all money involved. This table summarizes evidence expectations. For private loans, you need the lender's income and tax records, bank statements, a loan agreement, and sometimes proof of your relationship. Risks include weak documentation and unexplained savings. For bank loans, you may use only personal assets as collateral, and you must show ownership, valuation, and how you originally acquired those assets, plus bank underwriting documents and the loan agreement. Risks include gaps in collateral provenance and timing inconsistencies. For your own funds, present employment and tax records, audited statements, and any contract supporting asset sales. Risks involve unexplained deposits and sudden wealth increases. Next, let us visualize the process interactions. This sequence diagram shows the interactions among the applicant, bank, private lender, and the investment vehicle. The applicant engages with the bank to secure a loan backed by personal assets, not by the project. In parallel, the applicant may arrange a private loan and receive funds with adequate documentation. The applicant then funds the investment and submits comprehensive source of funds evidence to the regulator. Maintaining clean, consistent records at each step reduces processing delays. Now, let us identify common pitfalls and solutions. Typical mistakes include pledging project assets as collateral, which is prohibited. Another frequent issue is unexplained or large deposits. Provide employment contracts, tax filings, and bank statements to establish provenance. Cash-heavy transaction histories can be mitigated with sworn statements, invoices, and audited summaries. Date or amount mismatches should be reconciled using a clear ledger with cross-references to exhibits. Finally, missing translations can be resolved with certified translations and appropriate notarizations. With these pitfalls addressed, we will summarize the key points. These are the key takeaways. Loans are permitted, but significantly increased documentation requirements. You cannot use project assets as collateral. Only your pre-owned personal assets are acceptable. Private loans are viable but require intense scrutiny of the lender's funds. Source of funds tracing follows every dollar to a clean, verifiable origin. A meticulous document index and fully reconciled bank statements are critical to success. Next, we present a formal disclaimer. Please note that this presentation is educational and does not constitute legal, tax, or financial advice. Requirements vary by jurisdiction and by program, and they change over time. You should consult qualified counsel licensed in the relevant country. Submitting false or incomplete documentation can lead to denial or legal penalties. Always confirm the latest requirements with official sources or accredited professionals. To conclude, let us summarize and then wrap up. In summary, apply the debt financing rules precisely. avoiding any use of project assets as collateral. Prepare full source of funds documentation for all parties involved, tracing to clean, verifiable origins. Build a reconciled and indexed evidence pack that includes certified translations. Anticipate red flags and address them proactively with thorough documentation. Finally, engage qualified professionals early to minimize risks and processing delays. Now, a quick thank you and a call to action. Thank you for watching. If you found this helpful, please like, share, and subscribe. Tell us in the comments how you are approaching source of funds documentation or what challenges you are facing. Your insights can help others. See you in the next video.